Good afternoon, everyone. This is Rich Swerbinski with the Mortgage Collaborative here with the rundown with Rob and Rich, our kind of weekend wrap up of all the latest happenings in the mortgage industry. And as I am now every Friday, actually we're off next Friday, but then starting the Friday after that, Friday the 13th, we're going to a weekly format. We've had great numbers and great response to the show. So we're going to make it weekly. So depending on, your point of view, that's either a good or a bad thing. But Rob, good to see you once again. How you doing?
I'm good. Thank you.
And, the Where's Waldo? Where are you this week? It's always someplace new.
As usual, staying one step ahead of the authorities. I got that ankle bracelet off a few months ago, and I've just been going wild. So today I happen to be at a friend's house in Geyserville, California, which is north of San Francisco, about an hour and a half, in one of the wine growing regions. So it's a very nice house, and it's a nice area. No complaints.
Very cool. Geyserville, is that related to, hot steam geysers in any way?
Yeah, there used to be a lot of geysers and hot springs in the area, and of course they're all capped off, or you have to pay to visit them. But yeah, Geyserville, exactly.
Okay. And as always, encourage interactivity throughout the program, which we usually have. So any comments, notes, thoughts, anything you want us to talk about, any reactions, anything we are talking about, please feel free to go ahead and pump it in the chat of the Q&A, and we will incorporate it into the program. So, and Matthew Hackett immediately says, get that Ridge Zin. Does that make any sense to you?
Beg your pardon?
Ridge Zinfandel, I'm assuming he's referencing.
There's a lot of wine in the area. I don't know.
All right, well, let's get into it. Rob, the big news of this week in the mortgage industry, just a lot of talk and speculation in the MBA reaction, along with other organizations, regarding language in a proposed version of a bill, the infrastructure bill, that would extend the 10 basis point guarantee fee hike that was initially put in 2011 to help combat payroll tax relief, set to expire here in 2021. But $21 billion evidently it creates by not letting it expire. So last week, the big news was FHFA eliminates the 50 basis point adverse market refi fee. This week, they want to not get rid of the 10 basis point guarantee fee hike. So what one hand giveth, the other hand taketh away. The latest in this confusing last 6 months of like mixed messages from government on housing. It's, on one side of the mouth, it's, fair housing, affordable housing, lower the barriers for first-time home buyers. Other side of the mouth, 10 basis points in rate to everybody who wants a home. So what are your readers saying about all this madness?
Well, you pretty much covered it, so we could probably go on to the next topic. No, you're right. I think it's important for people in the industry to remember back to 2011, and we were coming out of the financial crisis, in part caused by the evil mortgage companies that were out there, and this 10 basis point G fee hike. And I'm so old, I remember when Freddie Mac and Fannie Mae, one had a guarantee fee and the other had a guarantor fee, and now they're just called G fees. And so this 10 basis point hit was put in place in 2011. And you're right, it expires in September this year, at the end of September, which isn't that far away. So this was put in place. As I recall, it was some infrastructure, some payroll tax extension, blah blah blah, some way of funding government programs. And the fact of the matter is, once the government has a source of revenue, and especially in this administration where they're scrambling for dollars, they are not going to give up any source of revenue. They're just not. And so if you look at, there was conjecture out there about the SALT, state and local tax cap, $10,000 deductibility on federal taxes. That's not going to happen either. So the government itself, and even in good times, the government is very, very hesitant about giving up any kind of source of revenue just in general. So you have this 10 basis points that's been out there, and the critics, or the not necessarily even the Elizabeth Warrens of the world, but analysts will tell us that, gee, mortgage world, you've been doing fine with this 10 basis point bump for all these years, and especially last year. It's not hurting anybody, certainly not hurting you lenders. And there are plenty of borrowers, refinancing or buying homes despite this 10 basis point hit. Of course, the industry is saying this is a tax on home buyers. Anybody who gets a conventional loan, is the G fee, is the extra G fee. It's a tax on them, and it's not right, and it's not even being used to help Fannie Mae or Freddie Mac come out of conservatorship. That was Calabria's big thing. So you have this money that's out there, and you're right, it's amounted to billions and billions and billions of dollars. But I agree. I think it'll just be extended or rolled up to support the infrastructure bill, because the government's going to have trouble paying for it. And so, yeah, I think we will hear a lot about it until the infrastructure bill is signed, and then we'll go back to business as usual. But it is a topic of conversation now. It's it is a lot of money, but I tend to agree, I think, with what you said earlier, and it's not really going anywhere. And the fact that the adverse market fee is going away, after Saturday, day after tomorrow, for loans above 125,000 that are being delivered to Fannie Mae and Freddie Mac and their refis, that's a great thing. But this 10 basis points, I think we're just going to have to deal with it.
It'll be interesting. I mean, that's $21 billion coming directly out of the pockets on a monthly basis in the form of higher interest rate on their home loans for everybody that buys or refinances a house. So it's very real money that's coming out of Americans' pockets. It's going to be interesting. You wonder if the elimination of the FHFA refi fee was partially done knowing that this would be put in the infrastructure bill. And to be clear, the bill is not final yet. Where this is coming from is notes that were released by some congressmen on the infrastructure bill and how it was going to be funded. It was in there. MBA caught it, saw it, immediately put together a very sternly worded letter, asking Congress not to use home buyers and G fees as their piggy bank. So will be really interesting to see how this develops, because it is really contrary to affordable home, making home ownership affordable. I mean, this is an extra 10 basis points in rate to everybody that buys a home. With the Biden administration on record, so many different ideas and proposals on how to make home ownership affordable. You have an affordability issue as it is right now with values and where they are. So be interesting to follow this and see how it develops. So
it leads into, or it's important for folks to remember that one of the reasons why, especially jumbo, but to some extent non-QM or non-agency loans, but more so jumbo, every once in a while somebody will write to me and ask, Rob, why are jumbo rates lower than conforming rates in my area for some $600,000 or $800,000 loan or whatever it might be? And I remind them that Fannie Mae and Freddie Mac have these G fees, and whereas jumbo lenders, jumbo investors don't. So that's a big advantage that the non-agency investors have, because they don't have that G fee. And in the meantime, yeah, Fannie Mae and Freddie Mac, the G fees are truly a source of revenue for them. And you don't want them to just not have any revenue. It is a source of revenue. We seem to be doing trillions of dollars of loans every year, with the things that are in place in terms of G fees and so forth and so on. So anyway, it's a little bit complicated, or very complicated, depending on how you look at it. But yeah, it'll be interesting. It'll give us something to talk about for some period of time until that bill is signed. And then after that, I think everyone will go back to saying it is what it is.
Other big news that's come out over the course of July here, Ginnie Mae put out a statement and some wording just in and around increasing capital and liquidity requirements on servicers. This is an issue that's tough for me. I understand both sides of it. You've got Ginnie Mae saying, listen, non-banks were 6% of Ginnie Mae servicers and issuers 10 years ago. Now they're 60%. They're regulated more loosely. They don't have to have as much capital on hand as a bank that's regulated by any of the various banking regulators. You've got the IMBs saying, listen, we're the ones that stepped in and have helped home ownership, have done FHA loans, have done the bulk of these loans when the big banks, Wells, Chase, and the others pulled back after the meltdown, and now we're being penalized. But you have the banks that, the non-money center banks that are saying, man, it's tough enough for us to compete with these IMBs the way that, they're regulated more loosely, some of the competitive advantages that they have. And we have to hold more capital as it is. And shouldn't all mortgage lenders be generally regulated the same? So a very divisive issue. Be interesting to see how this comes down. Again, though, this is, if this were to be put in place with 60% of Ginnie issuers being non-banks, and in theory, they'd be held to higher capital and liquidity requirements, that would have to come from somewhere. And that would again come from home buyers. So what have you heard on this issue from the reader base and just in general?
Yeah, the readers, the emails that I've received on that are really a mixed bag. It's not as cut and dried as you might think, because capital is king, and banks have a lot of capital, and so they are viewed with more, or I should say, as more stable than thinly capitalized independent mortgage banks. Now, independent mortgage banks are highly regulated, maybe not the same way as banks, but independent mortgage banks have plenty of regulations. The interesting thing about independent mortgage banks is that, that we had a very good year. We had a very good 2020. And so, did owners leave that money in their coffers, on their balance sheet, or did they take it out and pay themselves dividends, or did they pay bonuses? What's going on with the capital with independent mortgage banks? The fact of the matter is, Ginnie Mae and everybody else, Ginnie Mae is a highly leveraged organization, entity within the US government. I think they've got 150 or 200 employees total, and X trillions of dollars of outstanding Ginnie Mae securities. So they certainly know about leverage, because they leverage their personnel. The question is, of course, is that Ginnie Mae is fully backed by the US government. It has an explicit government guarantee. Fannie Mae and Freddie Mac, they're under conservatorship. There's still an implicit guarantee. So basically, the taxpayer is backing whatever Ginnie Mae does, and FHA and VA. So I do get a lot of emails on both sides of that equation. Of course, the independent mortgage bankers are saying, we shouldn't be forced to have more capital just because we issue Ginnie Mae's. And to your point, yeah, we helped save this industry. You know, Wells or Chase especially backed out of FHA. We stepped in when they stepped out, kind of thing. And we should be, rewarded for that, at least not penalized by asking us to have more capital, more skin in the game. On the other hand, you have a lot of regulators and politicians and banks saying, yeah, they should step up because it's the taxpayer who's at risk. I would imagine that given the current environment with regard to the Biden administration, and just given the sense from what I'm getting in my emails, I think that higher capital will be put in place, and independent mortgage banks will have to deal with it. And if they don't want to deal with it, they can, don't shoot the messenger here. I'm not saying I agree or disagree, but there are those out there saying independent mortgage banks who don't want to be Ginnie Mae issuers anymore, or who don't have the capital. They can sell that product to, an aggregator, PennyMac, AmeriHome, Wells, whoever, and just deal with it that way. So I think that'll be more of an interesting topic than, say, the 10 basis point G fee. I tend to think, Rich, that we'll probably see another hit in the industry in terms of higher capital for independent mortgage banks, especially those who are servicing Ginnie Mae pools and FHA and VA loans. But that's just a feeling. I don't know that. I don't have any kind of special insight, but I would think that's going to happen.
This is the Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as I always am by Rob Krisman. Rob, the competitive climate right now, just in talking to our lender members, it's been a busy July for new apps, especially these last few weeks. We've seen existing home sales tick up a little bit in June after it slowly subsided in March and April and May, just due to the inventory issues. Interest rates, because, largely due to the Delta variant and pandemic related fears, have dropped back down into the high twos, 30-year fixed rate for the best credit borrowers. So it's brought some refi back into the mix. I think that people selling homes have, chilled out a little bit and, brought the prices down a little bit. That's helped with home sales a little bit. On top of all that, so we're 7 months into the year. It's been very busy. The interest rate climate expected to stay low. Federal Reserve this week coming out, Jay Powell, a ways away, the word he used from a taper. They got specific questions about mortgage-backed security tapering before treasuries. And he said there are some that have that opinion, but they're not the majority. They are the minority. So not only did he kick the taper can down the road, but also kick the, let's stop buying MBS can down the road. And then on top of all that, this budding sense that I have, and I go back to our head of marketing. She's 25 years old, and she made a comment on one of her calls this week, how like all her friends are just like millennials that are just dying to buy houses, but they're on the sidelines right now because they tired of, the escalating prices and all the madness that we saw in the spring and summer. I feel like there's this shadow inventory of buyers out there that are just waiting. And I don't necessarily think home prices are going to come down, but I think they're going to get sick of waiting when we get into the fall. Fannie Mae and Freddie Mac upped their projections for this year to almost $4 trillion. The industry did $4 trillion last year, a record. I think both are on record now at 3.9. This is going to be as big of a year as last year, it's looking like.
Yeah, it's always interesting, the big numbers that get thrown around with our industry. And you're right, they have upped their projections. And when I talk to lock desks around the nation and loan officers, it's not like drinking out of a fire hose like we were a year ago with everything that was going on in terms of loan production. But business is good. Business continues to be good. And once again, don't shoot the messenger, but it's a good time to be in the lending business, whether you're a lender or a vendor, or running an organization like the Mortgage Collaborative that sees its members doing well, and it's a great feeling. The fact of the matter is that there is a pent-up demand for housing. I know that sales of new homes fell in June. They were down like 6.6%. And folks on the call need to remember there's always different sides to these statistics. So you say, oh, wow, new home sales plummeted in June. And that's like a headline grabbing, announcement. Ooh, oh my gosh, what's going to happen? Well, why did it happen? Did it happen because rates went up? No. Did it happen because nobody wants to buy a home? I would say no. The fact of the matter is there's just not a lot of new homes coming on the market, and existing homes are, suffer from the same issue about why sales in a given month go up or down. I agree 100% with what you just said. I don't even call them shadow buyers. I just know there are people out there. These for years we were talking as an industry about, oh my gosh, when are the millennials going to want to buy a home? When are they going to get married? When are they going to have kids? When are they going to buy a dog or adopt a dog? What are they going to do next? What am I going to do with all the trophies they have in my basement that they won, showing up to play soccer? There's this whole millennial generation out there that they need a place to live, and they want a place to live. And the pandemic allowed them to work remotely and go other places. And sure enough, when you look at some of the demographics about what's going on and what is happening in the suburban areas or the country areas or other states besides employment hubs like Manhattan or San Francisco or Los Angeles, if you're an executive in the Santa Clara Valley and you can work from home, well, heck, I'm going to go to Coeur d'Alene, or I'm going to go live near my parents in Bismarck or whatever it might be. And so a lot of people have been moving around, and they want to buy homes, and they don't necessarily want to give up their home near their office because, gosh, what if their office says, okay, everybody back to work, everybody back in the office? You're a executive working for Morgan Stanley in downtown Manhattan, and COVID hits. Everybody's working from home, so you buy a place in upstate, Vermont, and suddenly the CEO of Morgan Stanley comes back within, I guess it was about a month ago, saying, all right, everybody back in the office. What do you do? So a lot of those people didn't sell their houses to begin with, and they've been buying houses in other parts of the nation. And of course, other parts of the nation are saying, what the heck? Look at all this price appreciation. So on top of that, you have people in their 20s and 30s who are starting families who don't want to be in an apartment, and rates are great. Typically payments are still less than the rent that they might be charged wherever they're living. And so on top of that, you have immigrants coming into the country. And so demographically, there's still a big demand for housing. And you'll see these reporters out there, and they might, talk about, single family home sales are down, or they missed expectation. But if you look at it over the long haul, just not month to month, but over the last year, you continue to see appreciation that's outpacing wage growth. You continue to see low interest rates, and you continue to see this demand for some place to raise a family, or just some place to own, almost regardless of where it is. So, you have some seasonal adjustments and so forth that you have to think about, but nonetheless, the wealth of most families has been increasing. If they don't own a home, they want to own a home. Like I said, like everybody on here knows, rates are low. So demographically, Rich, I agree with what you're saying. I just don't see any kind of plummeting home prices. On top of all that, now you really got me going here, but there's a lot of underwriters on this call. Underwriters will tell you that the the credit profile, the ability to repay for borrowers now is much better than it was, say, 10, 12, 15 years ago. And so the home ownership base, the people who own homes are in much better position than they were in 2006, 2008 with stated this and stated that and so forth and so on, the way appraisals work and so forth, and just the pride of ownership, et cetera, et cetera, et cetera. There's not a lot that points to a plummeting housing market. And I know people who are out there who, including myself, well, not so much myself, but there are people out there who say, if values really start to go down, I want to own a second home somewhere, or I want to own a place in the city, get a little 2-bedroom, 1-bath place in downtown Dallas or downtown Minneapolis in some, converted warehouse. So there's a demand that's out there that, I think we're going to have a good lending environment for quite some time. All right, I'll stop screaming now and
Oh, that was a very informative and well thought out soliloquy there. But you know me, I'm a big stock market guy. I really feel I'm right now big in the housing and mortgage sector. I just feel like the market is underestimating just how hot the mortgage market still is and how hot it's going to be. Zillow came out with a report this week saying only 22% of people eligible to refinance their mortgage did so between April 2021 and 2022. You got 30-year fixed rates back in the twos. You mentioned a lot of different reasons why the purchase demand is unlikely to let up. I agree with you. I think values are not going to go down at all. I think they're going to continue to incrementally inch up as we get into the fall and the winter. And a lot of these millennials that are on the sideline right now that think that home values are going to come back down from where they shot up to this spring. They're just going to say, I'm sick of waiting. I want a house. People that from going into an apartment, into a starter home, or the people in a mid-level home that, want to get into a bigger luxury home. Another interesting report this week from Redfin, just on year over year home prices in general. Luxury homes up 26% year over year. And then the lowest price tier of homes, which I forget what they called it, but up 19% year over year. All the tranches in the middle, about 13, 14% in value year over year. Another interesting dynamic and trend we're seeing develop where homes at the bottom and the top are appreciating at a much greater pace than all these homes in the middle. And the homes in the middle are the ones that are being built, not being a ton of homes being built, but so I think it's just going to create more pressure on affordable housing at the bottom. And then, on the upside as well, these bigger homes, I think, are going to continue to skyrocket in value. It's going to be something that's very interesting to watch how that develops as well.
Yeah, and I know we're out of time. We're out of time here, but as a personal anecdote, recently earlier this week, I played tennis with a retired postal worker in Truckee, California, and who happened to live about 150 yards away from this plane crash on Monday. This private plane that crashed, and so being the looky-loo that I am, he invited me over to his house and to go look at this plane wreck, which is terrible. It's a tragedy. But he said, "How much do you think I paid for this house?" And it's a regular house. I mean, it's nothing great in Truckee, which is north of Lake Tahoe. And I said, I said, "When did you buy it?" He said, "Well, that'll give it away." I said, "Well, when did you buy it?" He said, "1995. And I said, I kind of looked around. I said, "I don't know, 150,000. And he said, "Wow, that's really good. You are like in the real estate lending business." Because I paid 145,000 for it. He said, "You know how much Zillow thinks it's worth now?" I said, "No." He goes, $880,000. And I'm thinking, what the heck? But of course I said, "Wow, that's great for you. What are you going to do?" And he said, what do you mean? What am I going to do? I have to live someplace. You know, where else am I going to where else am I going to be able to buy a house like that that's in a decent area? He goes, I'm just going to hang on to it. So you have a lot of people out there who, once again, they need a place to live. And they've watched their balance sheet improve because the value of their property is going up probably faster than their wages are going up. But you have a situation where people want a place to live. And even if this guy were offered $1 million, the first house, he'd probably turn it down just because he needs to live somewhere. People want to hang on to their homes. I mean, Rich, like if somebody came in and you're a new homeowner, relatively new, last few months or this year, if somebody offered you, you know, $500,000 more than what you bought it for, you might, I mean, $500,000. Well, at some point, you know, it's a tipping point, but a lot more than you bought it for, you probably think, no, I like it here. We bought this house for a reason. I'm going to hang on to it. They could carry me out feet first, you know, 50 years from now, my house. I like this house. And so a lot of people are out there and they're hanging on to their real estate.
Yeah, absolutely. We are about out of time, but we did have a few questions come in. Thoughts about the prospect of the investment property percentage quota being rolled back through FHFA, Fannie Freddie, cap and non-owner. I mean, my guess is there's a pretty good chance of that. Your thoughts?
I think there's a very good chance of that. But what viewers need to keep in mind is that it's easy for Sandra Thompson. Well, it's not easy, but I mean, she has the ability to, you know, change the adverse market fee. But that different other program changes that Director Calabria involved other departments like the Treasury Department. And so when FHFA has to go back to another department, it's not Sandra calling Janet Yellen saying, hey, you know, I need to change this. And Janet Yellen is saying, sure, go ahead. It's very complicated. The mechanics are complicated. It's going to take a long time for some of these other changes to be made. But I definitely think that Sandra Thompson is much more open to industry input. And I think that those changes will be made, just not quickly, just not as quickly as the adverse market fee.
And we're trying to get Sandra to come out to our winter conference in a couple months here, just outside Los Angeles at Terranea in September. Waiting to hear back. Hopeful to have her out. It would be great to hear her speak and have our members be able to ask her some questions. So another question that came in just related to the increased Ginnie Mae proposed capital requirements on non-banks and the impact that could have on, you know, just the rates and costs for home buyers on those products. Do you expect a bigger segment of that market to go the private MI route? That's definitely possible, especially if the MI companies maybe, you know, that black box pricing, get a couple basis points more aggressive, you know, in some areas that go heads up against government loans. Typically, you could see that totally, right?
I could.
Yeah,
I could. You know, the MI companies are in a tough spot. They are there's 5 or 6 of them and they all know each other and they all are dealing with the same competitive pressures, which is, you know, the rate engine. And so they all know each other's rates. And so, yeah, we could see some continued price pressure on the private MI companies, certainly.
Speaking of stocks, the MIs right now, I love the MIs. Just that, you know, if you are a believer that home values are, you know, not that this is not artificial, and that you could see a little bit more increase. Obviously, that helps the MI companies and their positioning. And just in general, I think the industry is making good loans right now. I really do believe that. Just, you know, all the technology, bad players being slowly eradicated from the marketplace. The proof is in the pudding. I mean, you take away the pandemic related, you know, forbearances and man, mortgage loans in America performed phenomenally well this last decade.
Even the forbearance numbers are coming down. They continue to improve. You know, this big tidal wave of disaster that so many people predicted back last April, May, June, it's not coming to pass. Our market is very, very strong.
And I think the stock market, you look at the prices of the MIs these last several weeks, they're starting to inch up, but I don't think it's fully it's fully baked in there. I think when you see earnings come out and delinquency numbers from the MIs when they report, it'll be strong. So, and this Ginnie Mae thing only stands to help them. So let's see what happens there. So, Rob, anything else you got for me before we call it a week here?
I'm good. Why are you, where are you going next week? Why aren't we having this next Friday?
I've got a little trip out to Denver to visit some of our good preferred partner clients. So,
Business
yeah.
travel.
What's that?
Business travel.
Business travel. Yeah. So,
Good.
be heading out there for that. And then, yeah, as noted earlier in the program, we're off next Friday, and then starting 2 weeks from today on Friday, the 13th, going weekly with the rundown, which I love because, love the conversation each week. So we have some cool guest hosts lined up already for August and September. And we're doing the rundown live at Terranea, the Tuesday of our conference coming up here, September, I think it's 20 or 21. During the lunch general session, we're gonna do the rundown live during the lunch general session. So
Do I have to wear long pants?
yeah, you have to wear pants. Yeah, I don't think they're gonna. That's a pretty nice place. I don't think they're gonna let you in there. Just a shirt.
Is that conference sold out, Rich? I know attendance is already ahead of estimates.
It is crazy. Our hotel room block, which we were nervous about filling, is completely sold out. Luckily, we have a backup room block at a gorgeous hotel on the ocean, on the beach.
What?
I mean,
It's not the Embassy Suites 10 miles inland?
no, it's the Portofino. It's a gorgeous elite property. We're gonna have shuttles that are running people back and forth to Terranea. But so registration is still open for the conference at mortgagecollaborative.com. But our room block at Terranea, I believe, is completely gone or almost gone.
Can I bunk with you?
I think you have a room. But yeah, you can if you want anyway. So. That would be a very interesting episode of the
We
rundown.
can talk about that in 2 weeks.
All right. Thank you very much to all of our attendees. Really appreciate you guys ending the work week with us every Friday at 3 p.m. Eastern. The rundown with Rob and Rich. We'll see you in 2 weeks, and have a great weekend, everybody. Take care.
Thank you, Rich. Take care.